Our fourth objective is to journalize and post adjusting entries. Okay, so what types of adjusting entries could we have? We could have adjustments to prepaid items such as rent, prepaid insurance, and supplies. We could have depreciation entries, which is recording a reduction in the book value of the fixed assets. We could have accrued expenses, which are expenses we've incurred but haven't yet paid. We could have accrued revenues, which are revenues that we've earned but have not yet been paid. And we could have unearned revenues, which is recognizing revenues that we've earned over a period of time. Okay? Next slide. Prepaid expenses. A prepaid expense is an advance payment of expenses. If we pay our rent in advance, if we pay our insurance in advance, if we pay for supplies in advance. If we've got any one of these examples, these are recorded as an asset. As the rent, insurance, or supplies are used over time, what we do is we make an adjusting entry at the end of the period to reflect the amount that's been used up as an expense. The adjusting entry reflects the amount of rent or insurance or supplies we've used up since the last accounting period. So if we turn to Chapter 3, Short Exercise 3-6, I think we have some adjusting entries to make. Okay? So, consider the facts in Short Exercise 3-5, where on April the 1st, your company prepaid 6 months worth of rent in the amount of $4,800. Okay? They want us to prepare the journal entry for the April 1st payment. So what we'll do on April the 1st is we will debit the prepaid rent for $4,800 and we'll credit cash for $4,800. Prepaid rent for 6 months. Okay? So, prepaid rent gets recorded in the journal and in the ledger account, as we see there. Then they want us to prepare the adjusting entry required at April 30th. April 30th, the end of the month, the end of the accounting period, we've used up 1 month's worth of rent. Okay? So what we'll do on that date is debit our rent expense for $800 and we'll credit our prepaid rent $800 to record the rent that expired in April. So, April 1st prepaid rent had a balance of $4,800. The ledger account rent expense gets a debit. The prepaid rent gets a credit for $800. So at the end of April, our prepaid rent has a balance of $4,000. Depreciation. Depreciation is where we take our long-lived assets that are used by the business. For example, buildings, equipment, furniture, computers, cars, trucks, vans, whatever long-term assets we are using in the business, except for land, we allocate the cost of that asset over its useful life. Okay? What's the useful life of an asset? Well, it depends. You've got to look that up in the accounting literature. If you're talking about a car, The useful life of a car is approximately 5 years. The useful life of a computer is probably 3 years. Okay, so we're taking the cost of that car, say $50,000, and we're allocating that $50,000 over the 5 years. So we would recognize depreciation expense of $10,000 per year each of the year for 5 years. So how do we record the entry? We debit the depreciation expense and we credit the accumulated depreciation. Okay, we debit the depreciation expense and we credit the accumulated depreciation. The accumulated depreciation is a contra asset account. This account right here would be listed after the automobile in our example. So you would have automobile $50,000 and then an accumulated depreciation for the automobile with a credit balance. A contra asset account means that it has a balance other than a normal debit. And the amount of depreciation, as this little oval here tells us, is based upon the depreciation method. My example of $10,000 per year was based on a straight line method. It's contra asset, as we said. It has a normal credit balance. It's always paired with the related asset account, like the car. It holds the sum of all depreciation recorded on the asset over its life. So, the asset minus the cost, the asset minus the accumulated depreciation would give us something that we term book value. So the book value of the asset is the $50,000 minus the accumulated depreciation. At the end of the first year, it would have a credit of $10,000. So the book value of the car would be $40,000. Book value has nothing to do with market value.